Okay, guys, let's start the topic. I was just trying to share the quiz link also, but it's due to some reason it's not getting connected. Yes, I'm audible now. Would you please confirm I'm audible now? Okay, I share the one quiz link in the group. So would you please quickly take a couple of minutes and complete that? Yes, please quickly confirm. I hope you completed that. Hope you guys completed that. So let's start today's session. So quickly, I just want to confirm our last topic was asset test. If I'm right, we were stop at asset test. So, but so let's start from here. The entitlement. Okay. Effective rate of tax in the PI greater than 9%, exceptional local companies. PI effective tax rate is more than 9%. What we are saying while we're selecting, we already covered. I'm just quickly refreshing the last slide and we'll continue from the topic. Because the next we have to do the one example also for the same. So if the exception, what is the exception? If the local companies and the UE companies, even the effective rate of tax is less than 9%, still it will be exempt. What we understand regarding this effective rate of tax in foreign PI, participating interest PI, the foreign PI, if the rate of tax in the foreign country is less than 9%, effective rate of tax is less than 9%, so then we cannot make the consider under the election option. So we cannot take under the election option. But here the point, the effective rate of tax, if the local PI effective tax of rate is less than 9%, then still we will consider the test is passed and is eligible for the PI exemption, participating interest exemption. Okay, so what are the scenario where the effective rate of tax will be less than 9%? First is the qualifying free zone. It will be zero rated. So you have the shares in that qualifying free zone. Even the tax rate is less than 9%. So still meeting the condition of the effective rate of tax and the PI. So next is the natural person and the list of exempt person. The list of exempt person, the natural resources, government entity, government control entity, the qualifying interest, qualifying investment funds, and the public qualifying benefit entities. So in day one, we already covered the list of this exempt person. So almost 10% that even they are, some is automatically exempt and some by application exempt. So that also will be subject to PI if you have the shares. Next is a business applied for the small business relief. And next is a holding company, investment in other companies. Investment in other companies. So this is the our point that we're going to discuss today. This is the our point. Investment in other companies, investment more than equal or greater than 50% qualifying PI. So this today we'll understand, start from there. So in our investment, what are the total qualifying PI? What we are saying the bad asset. So our investment will be more than 50%. We will discuss the bad asset. Okay. Effective rate of tax. We already discussed in the effective rate of tax, 1 million taxable. So we are just gonna see how to calculate the effective rate of tax. Effective rate of tax in the UAE for this company only. Here we are just looking how to calculate the effective rate of tax. For this company means if is it 1 million is a taxable income, how we calculate the effective rate of tax? First 375,000 is zero rated, and the balance will be 9%. So balance will be 9%. So now how much the tax will be? 625,000 by 9%. So 56,000. So now to calculate the effective tax rate, 56,000 divided by 1 million into 100. So 5.26 is our effective tax rate. So this exercise we did to understand how to calculate the effective tax rate. This effective rate only for this scenario. Maybe for next scenario, when the income is changed, company is changed, it will be changed. Okay. Here we did the exercise on the illustrative purpose, how to calculate the effective tax rate. So next condition is effective tax rate in that PI more than or equal to 9%. So effective tax rate in the foreign company. So this we understand in foreign company, how we calculate the effective tax rate. Rule number one, based on the accounting profit, not on taxable income, because here we calculating based on the taxable income. But for the effective rate calculation purpose, we will calculate on the accounting profit, not the taxable income. So let's see, taxable income is the 400 and the tax rate is a 5%. Okay, tax rate is a 5% in foreign jurisdiction. Because what we said, if the effective rate of tax in foreign jurisdiction is less than 9%, so we cannot consider in the election. Okay. Let's see how to calculate the effective rate of tax. The effective rate foreign country, we have the 5%. Taxable income is the 4,400,000, and so now this is not the tax rate. This is the tax payable. Tax payable, because 400 into 5%. This is the tax payable. So accounting profit is a 200. Accounting profit is a 200 because maybe we have the 200 accounting profit and then we made the adjustment to reach to the taxable income. So that's why taxable income is a higher. So normally we start our tax calculation from the accounting profit and then we do add or minus to reach to the taxable income. So now we see the effective tax rate, 20,000 divided by accounting profit is a 10%. So greater than 9%. So our test is a pass. Now the accounting profit must be under IFRS. So what we are saying, if we given this information or the company in foreign company of the information, if their accounting profit is calculated based on the gaps, maybe the US gap they use or different accounting standard is used. Normally we familiar with the IFRS and the gaps in US. So if you have the company in the US and that accounting profit based on the US GAAP calculation, then you have to calculate as per the IFRS. So you have to retranslate the accounting profit, now recalculate the accounting profit as per the IFRS, and then you will calculate the effective tax rate. So rate of tax is a 5%. The US GAAP accounting profit is a 400. Okay. So IFRS profit is a 200. So here we taken only the information, but in practical scenario, we have to do this calculation based on the each scenario. So taxable income is a 400. Here the difference is the taxable income and the US GAAP profit is a 400 both, but accounting profit as per IFRS is 200. So now we have to calculate the tax rate is a 400 into 5% is a 20,000. This is the tax payable than 10%. So test is a pass. Now the next is a entitlement test. Entitlement test. This is the one of the important factor. Entitlement means we since beginning first session we are discussing the entitlement test means the equity shares. Equity shares means where they our voting right PI must pass entitlement test. The voting rights normally we are saying the equity share we have the voting right also. So now the asset right also. But in the certain circumstances where the redeemable preference share, maybe we do not have the voting rights, maybe we do not have the asset 5% or greater than 5% asset, because redeemable preference share, they are more concerned about the their profit. Okay, so regardless, company will go in company financial profits based on their preference redeemable shares. But here we are just considering that entitlement test. PI must pass the entitlement test. How we pass the test? The equal or more than 5% of the profit will be shared in case of the liquidation. When you go in the liquidation, so you must they must give you, okay, you have the right for the net profit 5% or more than 5%, and the equity total asset minus total liability. So net asset more than 5%, you will have the entitlement. Okay, now here we use the word how we calculate the effective tax rate. So I just took the this screenshot from the Ministerial Decision 116, in which they said if it recalculates its accounting profit according to the basis provided for the corporate tax. So it's recalculate accounting profit. In the previous example here, we seen the effective rate of tax. Effective rate of tax will base on the accounting profit. Just the reference purpose from where it's coming, accounting profit, I just added the Ministerial Decision 116, the relevant Article 6, Clause B. Okay. So if it recalculates its accounting net profit according to the basis provided for in the corporate tax, the tax laid on such profit, then this would result in the effective rate of tax not less than 9%. If you go and read and this clause, you may not understand, but now I'm giving you the understanding how what is the meaning of this clause. So let's move to the today topic from where it's gonna start that. So now we've seen that in this, I'm gonna give you again. Here we said the more than 50% qualifying investment, more than 50% qualifying investment. Okay, so now another test for the same that we are gonna look today. PI asset should be qualifying asset more than 50%. How? What is the more than 50%? How we calculate the more than 50%? So let's see. What does mean? It means if you made the investment in the if the holding company have the investment in any group of companies. Let's give you the example. If the holding company, what is the holding company? Holding company, they normally take the investment funds and they will invest in different companies. Maybe A, B, C, and D. If he's investing the holding company, because his main activity will be to invest in the different companies. So now this is the investment. So this is the one of the asset. This is the second asset, third asset, fourth asset. So now how we will calculate this qualifying? So let's go to the next point. PI should not have bad asset more than 50% of the total asset. 50% of the total asset. If this company total asset, so total asset, how much the bad asset? Bad asset means the loss making asset, okay? The loss making the investment. So let's see the next example. Investment by PI, business which is not the PI, okay? So they will make the investment in the different, because if we have the investment over here and he is investing in the different asset that maybe directly we are considering is not the PI, maybe the 2%, maybe 3%, maybe 4%, maybe another 1%. So standalone, they are not meeting the PI condition. But we invested over here. We invested over here. So here we have the 5% condition that we are meeting the condition. Here, the company that we are discussing, he invested in the holding company, and holding company is investing in the further investment by PI business. PI business, this is the PI, which is not in the PI. So let's see. So now I hope you understand this. I'm just going to take the example. Company A buy 10% share of company B. The PI, the balance sheet. Okay. Now here we given the taken the example, the company A. So here we are saying this is the company A, and this is for the example purpose the company B. Just as the example, as holding company, he buy the shares of the A company. So now we're gonna see the balance sheet of this company. Balance sheet of this company. Let me take this. Okay, let's say the holding company A, he buy the investment in company B. So this is the company B. So here the company A, we are already meeting the condition of the 10%, the PI. Now he's investing in company B. So now we're gonna see the balance sheet of this company. So let's see, the total asset is a 100. Let me just raise this. Okay, now the company A buy the share company B, the PI, the balance sheet of the company B, that is not our PI. The total asset is 100,000. Investment into multiple companies, multiple companies is 40,000. I just yellow highlighted for the understanding. The company B invested into multiple companies. Okay. Now the qualifying investment in another companies greater than 5% PI, qualifying investment in other companies. If we are saying the qualifying investment in other companies means if this company B, the company B, if he's investing, this is company B, if he's investing further here, okay. So here we are saying if the X by Z. So what does it mean? What mean? He's saying the qualifying investment in other companies. If he invested here the 5% and greater than, so this is a good asset. This is a good asset. Okay. So let's see now here the example company A invested in the B company, and the B company total asset is 100K, and he invested the 40,000 into multiple companies. So good asset, if the 10,000, now we just gonna calculate the bad asset. Okay, so how we gonna calculate the bad asset? If investment, qualifying investment in other companies, all this we are talking about. So 10,000, so 30,000. What is it? 30,000. So this is the 40,000. If you're gonna see that, this will be 100. 10 will be more over here. So let's see this 40,000 minus. So this is the 30,000. So balance is 30,000 is divided by 100. This is the 100 total asset divided by total asset. So divided by total asset. If divided by total asset, so we are saying this is the 30%. So 30% is less than 50%. Less than 50%. What we gonna see the example? If the 5% PI having the more than so this is the good asset, the definition, this is the good asset. So how much the good asset is 10,000. So total investment is a 40,000. From that, if we take the 10,000 out, so balance is a 30,000. Here we are just taking the example for the calculation purpose. If we're saying from the 40,000, 10,000 is a good asset. What is a good asset? Qualifying investment in other company equal or more than 5%. Okay. So we are considering if we made the investment in another company by big in another company is more than 5%, these are the good assets. And as of now, we have only this much asset that is meeting the condition of PI 5%. And the balance, how much? Balance is the 30,000. 30,000, how? 40,000 minus 10,000. 10,000 is a good asset and balance is the bad asset. So now the bad asset, what is the percentage against the total asset? 30,000, total asset is 100, so it's coming 30,000. So test is a pass. So let's see that another example, non-qualifying investment in other company. Here we said the qualifying investment, here now non-qualifying, bad asset. So let's see the bad asset, 30,000. Compare bad asset with the total investment, not with the investment, not with the this investment. Again, you note the point here, the total investment. This is the total investment. Compare bad asset with the total investment, not with the this investment. Here will be total asset. Here we can write the total asset. If we write the total asset, so hope you understand this point. I'm just gonna quickly. So would you please confirm till this point you understand how to calculate the bad asset? Yes, now we are considering the PI in foreign. We are considering the PI in foreign. Because local, we already seen the example. In local, we already seen the example in the previous, the exception exemption also. So here is here we said that 50% not have the bad asset more than 50% of the total asset. This is our calculation. So we are saying here the in investment, we know rules. Okay, what is the party and interest exemption? We go through in the okay, guys. Up to this point is covered. So let's see the next one. So is now what is the participation exemption? So there is a fourth major point in the participation exemption that we're going to see that is the foreign dividend, capital gain and losses. So under capital gain, the foreign company and the UAE company. The foreign dividend, we already go through all the tests. So now we are on the under participation exemption. The second point, capital gain and losses. Then the third point is the foreign exchange gain and losses on PI. Impairment loss and gain. Impairment losses 20,000. So let's see this impairment losses. Now we are seeing the impairment losses is this. Okay, we want to do this example first. I think the last time we did not do this example. The example, the liquidation loss, company A holds 100% share of the company D. This is the under liquidation. Company A hold 100% share of the company D. So let me. This is the company A holding the share of D. Both are resident and incorporated in the UAE. So this is the second point we have to see is resident or non-resident. If resident, then we have to see this is the juridical person or natural person. So here he said the incorporated. So what we're saying the juridical person. resident. The acquisition cost of the participating interest in the company D is 50,000. The market value of the company D net asset is 10,000. During the tax period ending 24, company paid a dividend of 10,000. In addition to this, company D transfer a tax losses of 20,000 to company A. Now here the point is that how much the company D, because it's meeting the condition of the participating interest, and how much the benefit or how much the benefit we enjoy under the corporate tax while having this 100% share, the PI. Okay. The acquisition cost was the 50,000. This is the acquisition cost. So we already know, so we will consider only the acquisition cost in the PI. Then the market net value of the company team net asset is at 10,000. So what we are discussing, the liquidation. So now under liquidation, we're going to see that how much the cost we can cover. How much the cost we can cover. Okay, the liquidation. Second is the 100% share of the PI. So we are saying the PI, we don't have to check the other condition. The PI status is getting met. Okay. So both are resident. The acquisition cost 50,000, market value is 10,000 at the date of sale. During the period, the company paid a dividend. 24, they paid the dividend. So let's say I'm gonna mention over here the cost. $50,000. Now the net asset market value is 10,000. Right. So as of now, if we see in liquidation, we have the loss of 40,000. As of now, if we're just looking at this stage, we have the loss because we are seeing the liquidation. In liquidation, how much we get? The 10,000. Okay, the 10,000 we are getting, so 40,000 is the loss. If 40,000 is loss, so now we have to see how much the benefit we enjoy during this PI. How much city benefit. So now we have to see how much the benefit we already enjoyed. What is the benefit? The benefit is that we receive the 10,000 dividend, so which means this dividend is a taxable or exempt. Is it taxable or exempt? Quickly reply. D is a taxable, E is exempt. Guys, quickly reply. Not all participants replied so far. Because why I'm involving you guys in this? Because we already learned all this point. So if you already know that point, so then it will be good to continue further also. Okay, so now we already know is exempt. Exempt means we did not pay the tax. In the 2024, due to this PI, due to PI exemption, we enjoyed the benefit of 10,000, right? So another is the loss also. In addition to this, the transferred a tax losses also to A. Just see another benefit, D company give 20,000 losses to A also. So what we see in the calling loss group. Loss group. So another benefit, 20,000. So here as so far 30,000 the benefit we enjoyed. The loss means he come to the A and he reduced the tax profit. Okay, due to this. Who deduct this from the taxable income? So A took all this benefit. On June 2025, company A resolved to liquidate D. It removed from the commercial register on 30th June. So liquidation happened on the 30th June. Ceased to have the legal existence. Legal fee incurred in relation to the liquidation is a 5,000. So how much the additional cost over here? The 5,000. So now if we seen here, the legal cost, so the legal cost will be this is the net asset. If we minus another 5,000, so this will be asset minus this expense, balance is a 5. So this will be 45. This will be 45. 45 and 30,000 is the losses. Now, if once I go to the next slide, then you will understand what is the topic over there. Let's see. I'm gonna, in this course of the liquidation, all the asset will be transferred to company A at the market value for the tax purpose. No application for relief. Because this is the loss group is automatic, we don't have to make the application. The liquidation loss is calculated as follows. Acquisition cost of the interest in company D is 50,000, same 50,000 we've seen. Liquidation proceed received by the company A market value net asset, D less the liquidation cost by the company D. So this 10,000, we already seen the net asset value, then the liquidation cost. So which means from 10,000 asset, we receive only 5,000. So this is the we minus here. So total is the 45,000. Equal liquidation loss is the 45,000. So far we have the 45,000 liquidation. But in the 45,000 liquidation, okay, this is the loss. So can we adjust this loss? Again, what we gonna understand the capital loss, okay? Capital gain and loss in the PI. So how much the loss we can adjust? So how much the loss we can adjust? This is the calculation. Now so what the rule is that the matching concept, because here if we already enjoy the benefit of 30,000, if we already enjoy the benefit of 30,000, so what this tax authority is saying, okay, from this loss, here you take on the benefit of 30,000. So minus this 30,000 that you already enjoyed the benefit in the previous tax period, and balance 15,000. This loss you can claim now. Anyhow, let's see. The liquidation loss that can be deducted from the taxable income, however, must be adjusted for the following item. Exempt dividend received in the 2024 10,000 preceding tax year. Okay. Transfer tax losses is a 20,000. Thus, the liquidation loss after the adjustment amount is a 15,000. 45,000 minus 10,000 minus 20,000. So difference is the balance is a 15,000. This much we can take the benefit in terms of the liquidation losses. So our answer will be 15,000. This is the impairment losses that we can understand the impairment losses, how it gonna work that. Impairment losses. Recoverable amount is 80,000, carrying amount is a 20,000, reversal of impairment losses. Let's see. Guys, you are familiar with the impairment losses? Okay, so now if we apply the impairment losses, the definition of impairment losses, yes, that's great, that's great. So now here under impairment losses, again the same point, if we already have the impairment loss, so while taking the benefit of the participating interest, so first we have to see how much the impairment loss we recorded. Okay, recoverable, how we do the impairment loss. We seen the recoverable value and the net book value. Normally to calculate the impairment losses, how we do that? Carrying amount is 100 and recoverable amount is 80,000. So 20,000 will be our impairment loss. What is the standard guideline further in detail that you guys already knows on that. But just for a common understanding, so how the impairment loss is coming, the difference between the recoverable value and the carrying amount. So this is the impairment loss. So again, reversal of impairment losses are possible. Reversal of impairment losses are possible again in case of the because if this loss we already recorded, which means we reduce our tax profit, right? This means we already reduce our tax profit. If we already reduce our tax profit, so same rule in previous we seen, we already enjoy the benefit in terms of the losses, in terms of the dividend. So same in terms of the liquidation also, or in terms of the enjoy, we want to take the benefit in terms of the liquidation or in terms of any stage. So we have to first see either in the previous year this asset is have the impairment losses. If we have the impairment losses, then we have to recover that impairment losses. Reversal of impairment losses are possible. So that based on the PI is the PI means participating interest. OI means ownership interest. So here we have to see the equity investment through profit and loss, fair value through OCI. So here we have to see if the impairment losses are recorded in the profit and loss, which means it's already impacted our tax If it's recorded in the OCI, maybe it's not impacted. So the next is the cost. Cost means the expected credit losses. We will do one example in this regard. So that's why I just share this understanding the reversal of the impairment loss. You may understand while doing this example, your understanding will be improved over there. Losses are expenses related to PI recorded into profit and loss. Same thing, the equity investment, if we recorded the fair value through profit and loss and the fair value through other comprehensive income. So now let's see the first example, the losses or expenses are recorded to the profit and loss. So this loss also will be recorded where? This 20,000 impairment loss will be recorded where? In the profit and loss or the OCI. Based on that, we will take the further action. The impairment loss, what we do, if we already minus the loss, so we already enjoy the benefit in the previous year. In this year, the same amount will be taxable. Same amount will be taxable. So how the taxable in specific scenario, we're gonna see that. Losses or expenses related to PI recorded into the profit and loss, non-deductible because it's already adjusted. Add it back to the profit and losses. Meeting the PI criteria. This is the add back to the profit and losses. If meeting the PI criteria, add back. If not meeting the participating interest, if no, then ignore. Now let's see the next part, the fair value through profit and loss. Expense. The losses under accounting, we will record through the fair value through profit and loss as the expense. As the example, the commission, the professional fee, we already seen in terms of the acquisition of the PI, if we did some expenses, so that will be part of the acquisition cost. So if we already expense out, such, so we have, because under accounting, we recorded through fair value through profit and loss. If OCI is the capital. So here the point, the learning for us in this point, we have to see where the expenses are recorded, and the same point we go to understand in the realized and unrealized gain and losses also, and in the PI also, participating interest exemption also, we have to consider the same where it's recorded. Accordingly, we'll do the adjustment. If recorded in the profit and loss and the impairment losses, so we are saying it's non-deductible, so we will add back. Okay. So next point is the interest on loan to purchase the PI is deductible under interest capping rule. So we already know the interest capping rule. But while doing the interest capping calculation, we already seen from the shares also, the debt investment also, the dividend on the redeemable preference share we are paying, that is will calculate under the interest capping rule. But now here we're going to see that the under PI also, if we paid the interest, what is this interest actually? Before that, I'll just give you the example for understanding. Normally we are, maybe you guys are also receiving the calls from the banks, from the credit card. What is the call? The bank will call and say, okay, because they have the data. When you take the credit card, you've given your detail, and if you have the salary account with the same bank, so they have the detail of yours. And even the other bank also, where you don't have salary account, they have the information. They will not tell you, but they have the information from backend. They will call you and they will say, okay, take the balance transfer free of interest and the free of profit. Free of interest or the free of profit without any processing fee. Or some they will say, okay, 1% processing fee and 12 months free of charge. If you receive such calls and you say, okay, let's say I have the 50,000 by paying 1% or even sometimes banks say, okay, because they know your balance and they'll say, okay, take free of charge. So now you take the loan from the bank free of charge. So what are you going to do that? So you will think where I can invest. So where I can invest so I can generate the additional source of income. So this here, let's say you have the processing fee. I'm just saying the processing fee. Processing fee, let's say the 2%. The 50,000, under the credit card, the balance transfer they will give you, okay, you have any other credit card or the balance transfer or the cash withdrawal. So you pay only 20% and pay in equal installment of 12 months. So this topic is closed. So now you have this investment. What you did, you buy the shares. You buy the shares in one of the company. You took the 50,000 and you invest. So now this processing fee that you paid for that, this is the interest on the loan. This loan you use to purchase the PI in the company, So this is your 2%. So now this 2% will be calculated under interest capping rule. It will be recorded in the PLN. Okay, it will be recorded in the PLN, but we have to add into interest capping rules. We have to add over here interest capping rule. Here you are taking the 2% of the 50,000, but if you look to the shares, where the companies are investing, that 2% also will be the big amount. Okay, so here we have to just take the idea what the impact is taking in which area of the city calculation. So if we took the loan and buy the shares, so that loans we are paying the interest or the processing fee or whatever the charges to take this money, so that will become under the interest capping rule that we already know in very detail. So this will be added over there. So just quickly, if I ask you what is the interest capping rule, guys, I will ask you what is the interest capping rule. Just quickly, please share your understanding interest capping rule. No one? Guys, you know the interest capping rule quickly. Yes. Yes, Mr. Adnan, thank you. You already covered the point. Okay. Farhana, you also covered. Ms. Kinjal also covered. Okay. So now what we understand the interest capping rule. So while calculating that threshold, limit, so you have to take this amount also under that. If you not take, maybe the error will be there. So hope you understand what is the point over here. Let's move to the next. Okay, the point 6. No PI exemption. When dividend is paid is a deductible expense of the paying company. When dividend paid is a deductible expense of the paying company. Redeemable preference share. Dividend paid is a deductible expense. Okay, this is just now we are discussing the redeemable preference share. The redeemable preference share Although the name is shown as a dividend, but actually this is the interest. Actually, this is the interest. So this dividend or the interest will be deducted in the income statement of the paying company. Income statement of the paying company. So which means once you receive the income, understand the point. Paying company. Because if I'm receiving the dividend, so what I have to see, under which arrangement I'm receiving. If redeemable preference share, so which means the other company recorded in the income statement. So then this income will be taxable for me. This income taxable for me because they recorded as the expense. For them is the interest, and this interest also will be calculated under the interest capping rule. This dividend will be part of the interest capping rule. So now what is the impact? I have to put in my city computation because once I receive the dividend, because if I'm the juridical person, I receive this dividend from another company, so then I have to record into my income. That will be receiving company taxable. Receiving company will be taxable. So normally we understand the dividend is exempt from local company is exempt, but even we see even the PI condition you are meeting, even the foreign scenario, the 5% and all this condition you are meeting, but further you have to understand this is the equity investment or the debt investment. In case of debt investment, you have to differentiate that dividend will be taxable from the receiving company, and this is the one of the example. Mostly we are using the abbreviation, okay, the PI, participating interest, the SPV, special purpose vehicle, the SBR, small business relief, ETR, effective tax rate, CT, registration, corporate tax registration, TI, taxable income, QI, qualifying investment. I just share the legend here to understand wherever we are using the abbreviation, the short name. Okay, now here we understand the paying company. Now we're gonna understand the another company. Okay, this was the paying company from this perspective. Now the getting company. So let's see. No PI exemption if loss has been recorded in the financial statement when it was not PI up to that loss amount, no exemption. So here the point is that no PI exemption if loss has been recorded in the financial statement when it was not PI. This is the other interesting point. This is another interesting point. So let's understand this interesting point. No PI exemption if loss has been recorded in the financial statement. What does this mean? This means no PI exemption if loss has been recorded in the financial statement when it was not PI. Let's say the company A. Company A made the investment in the company B. So let's say he have the losses. He have the losses. Let's say here is a 3%. 3% will not make the PI. Okay. So here we buy the 2% after 1 year. After 1 year. So 3% is here and 2% is here. Then we met the condition of the PI. At this stage, okay, that is, let's say this is the 23, and year after this is the 24. So now what, at this stage, we are PI by having the another 2%. If we are PI, so what we are saying, if the losses that is the previously we recorded, no PI exemption if losses has been recorded in the financial statement. What is saying? If in the financial statement of the A, if we already recorded the losses, okay, so we cannot take the PI exemption up to same amount. Let's say the losses was 10,000. Okay, in between we have the 10,000 the losses from this to this, from 2003 to 2004. So now if you have the dividend income here, if you have the dividend income, let's say the 15,000. So now you have the PI interest and you have the dividend income 15,000. So what they is saying, no PI exemption if loss has been recorded in the financial statement when it was not PI up to that loss amount, up to that. So this is the problem. This is the problem. He said, yes, you are meeting the PI condition, but you already have the recorded the losses. So up to that amount, you cannot take the benefit because you already taken the advantage. How the advantage? Because this 15,000 gonna exempt. If this gonna exempt, you means you will reduce your taxable profit, taxable income. But you already have the 10,000 in previous year, you already reduced the 10,000 taxable profit, right? You already enjoy the tax profit. You already enjoy the tax benefit, up to 10,000. So this means up to this amount you cannot deduct. So balance 5,000 will be exempt. If we see in total, we already taken the 10,000 benefit. Now we take the difference only. Actually, we are taking the 15,000, but they said the 10,000 you already taken in the previously. So that you cannot, that you have to adjust from this income. No PI exemption if loss has been recorded in the financial statement when it was not. So this part. Guys, you understand the point? So this part we already adjusted here and the balance we can take the benefit. Guys, quickly, do you understand that? Do you understand that? Okay, now let's see the next part. Okay, here the example is there. I already explained, but now let's see this example. Year 1, purchase investment of 2%, no PI losses. It would be 50,000, not okay. Recorded in the income statement, fair value loss. Okay. Taxable profit is lower by the same amount. Now let's see the next. Okay. This is the first. Now, if loan has been recovered, if this is just okay. So here the loss is 50,000. Now see the next point. Next point is that, if the loss has been recovered to PI by taxable person or his related profit more than 50%. Loss has been recorded on to this loss in previous year up to that loss amount, no PI exemption. The same point we are going to understand that the year one, the loss is 50,000. This is loss. Okay, here the animation is not appropriate. Let's continue the same. Okay, first we're gonna see that this part. Year one purchase investment of 2%, no PI, loss is 50,000 recorded in the income statement through fair value profit and loss. Taxable profit is a lower of. And year two, the same, we purchase another 3% and we purchase 3%, so we become the PI, right? Total is 5% now. 2 is here, 3 is here. And how much the dividend we received? 80,000. So taxable up to the loss of up to loss recorded in the previous year, 50,000 as enjoy the tax benefit. So the same point we said this amount cannot be exempt, but because the previously we already minus, right? Previously already minus, so balance 30,000 will be exempt now. From 80,000, 50,000, because we already minus the loss, so it will be adjusted against that, so it will be taxable, and above 30,000 will be exempt. Now the next point, if loss has been recovered to PI by taxable person or is the related profit more than 50%, loss has been recorded on this loan in the previous year. Then up to the loss amount, no PI exemption. The same point. If 10,000, we already recorded the loss, and here's the 80,000, and here is the 50,000. So 10,000 is the taxable, 40,000 is the exempt. Because in year one, we already recorded the 10,000 loss. In year one, we already recorded the 10,000 is loss. Okay, now we're gonna see the summarize this and take the exercise. The dividend income, distribution of profit received from UAE resident, exempt income. This is the same understanding that we go through in the previous two sessions. Now I'm just going to summarize and then quickly we'll go to the exercise. Without any condition, less than or more than 5%, holding less than or more than investment 4 million, less than or more than 12-month holding condition also, where dividend received from the UE resident, juridical person. If we add the juridical person, understanding will be complete. If dividend received from the UE from non-resident, exempt income subject to Article 23 condition of the participating. So we already seen all the condition. That condition to be met, then it will be exempt. Now, capital gain on disposal of share. So this is the next point, the capital gain. The capital gain on disposal of shares. So disposal of UE resident shares, disposal of non-UE resident shares. Exempt income subject to Article 23, that we already seen that. Other income from participating interest income or loan to participating interest will be subject to tax, even the investment meeting the PI condition. That we already discussed in the just today in the first or the second example. We understand if we are receiving the interest, the redeemable preference share, then we are receiving the interest, and that paying company recorded as a expense, then it will be taxable into our books. Dividend from the UE resident company exempt. Dividend gain received from the foreign permanent interest, foreign participating interest exempt business need to review their legal entity structure and their profit repatriation strategies. Okay, asset test. Less than 50% of the participating interest would not have qualified for the participating interest, even if held exempt as a percentage of the total asset, not the total investment. This is, we understand the bad asset. We just discussed today the bad asset. So we are saying the asset test, that investment, the where they are making the investment, it should, the investment in the bad asset, where the interest is not less than 5%, so it should be less than 5%. If it is more than 5%, so this will be the asset test will be failed. We given the name the bad asset, so we are saying the bad asset should not be more than 50% of the total investment. Ownership test, participating interest more than 5% shareholding voting rights, net asset on liquidation. Acquisition cost, minimum acquisition cost more than or equal to 4 million, including the expense incurred, acquisition cost, legal fee, professional fee, we are saying. Then we are saying the 84 million at the time of the contribution. Ignore the fair value. Change in fair value, we already seen what is the change in fair value. Here I'm just summarizing the bullet point, but the concept we already understand. The participating interest exemption, Article 23, no election required. The participation exemption automatically available, no election, no application. FTA guidelines, foreign capital gain, actual holding is 12 months. On the capital gain, actual holding period is a 12 month, and in certain scenario is 24 month as well. Investment in the foreign participant exchange rate at the acquisition date. We already learned that the exchange rate at the date of acquisition we will use. No exemption for dividend which are deductible expense, no exemption for dividend which are deductible expense. Same we understand, if we expense recorded in the profit and loss, so then no exemption, it will be subject to tax. Holding period test must be held or intend to held for the uninterrupted period of 12 months. Okay, in terms of the dividend, we seen the holding for 12 months, and even we have the intention for the 12 month, the dividend received will be exempt if meeting all the condition. But in case if we sold in the next year before the 12 month, then it will be taxable in that year. The next tax test subject to tax test means effective rate of tax. So how we go calculating the effective rate of tax? We already seen even the foreign company, foreign PI, we have to retranslate their accounting profit to the as per IFRS if is in the US GAAP or any other standard. So we have to calculate the effective rate of tax. Okay, maybe based on their calculation, we did the taxable income calculation, it will be not the effective rate. But if we have to calculate based on the accounting profit, it will meet the effective rate of tax. Breach of any condition, exempt income will be taxable in the year of breach. What that mean? That previously, if we have dividend, if we have the intention to hold 12 months, but we already received the dividend before 12 months, so we already taken the benefit. But the next year, if we breach the, we sold before 12 months, it will be taxable in that year. So this is the mean of breach of any condition. Exempt income will be taxable in that in the year of breach. Profit and liquidation proceed test entitled to 5% of the profit distribution and liquidation proceed. Parent company A, parent company, mainland company, 4%. Company A, parent company, mainland UAE company. Okay. Company B, UAE company, city at the name 9% investment is the 1,000 holding period is the 3 years. 10% capital share. So here we are just taking the example for understanding, and this company A hold 4% share here, then 10% share here. Bermuda, we are saying the tax rate is a 0%. Investment is a 5 million. Let's see the next. Now company A, 80% share capital in company D, UK. See the effective tax rate. Effective tax rate. This is our understanding. 80%. All we have to see the meeting the condition PI or no. Here the 100% share capital. Company E, UE company, city is 9%. Okay. UAE company tax rate is a 9%, investment is a 5 million, period is 6 months, but intend to hold for 3 years. So let me write here the would you please, now I need your participation. If company A have the 4% share in company B, UE company, just UE company, okay? 9% and investment is a 1 million and holding period is a 3 year. So dividend will be exempt or no? Guys, I need your participation. Why dividend is exempt? Even is failing the condition. Even is failing the condition. Yes. The word was UE company. So under UE company, we are saying the dividend will be exempt because the paying company already paid after the tax. Okay. But here you have to go through if it is a dividend, yes, it is exempt. But if it is the uh, redeemable preference share, then it will not be exempt. You understand the difference? If you're receiving the dividend, yes, it is exempt. But if you're receiving the redeemable preference share, the dividend, so that dividend will be taxable because that is by name is a dividend, but actually is not dividend. Yes, and the capital gain also, yes or no? Let's complete the dividend part. Okay. So here the company C, Bermuda, this is not UAE company, and the rate of tax is a 5%. Investment is a 5 million. Investment is a 5 million. Yes, it is the taxable. I'm just making the cross. Cross means the taxable. Okay, so now the capital gain, they said, okay, this is also taxable. Now the next UK company. Now the UK company. Guys, quickly. The UK company is saying the exempt. Why is it exempt? Because the 19% and the 4 year, okay, everything going good. And investment is the 4.5 million. We need the 4 million. Okay. Now the last E. Last E. Here the 9% investment is the 5 million. The condition is done investment. He hold for 6 months, but intend to hold for the 3 year. So it's good to go. It's good to go. So let's we said exempt and taxable, taxable. Here the because this is the exempt the UE dividend, but the capital gain and losses come under the PI. Even the UE company coming under PI. So PI condition is not meeting because investment is less than 100. Investment is less than 100. So that's why is it taxable because PI condition is not meeting. Here is the taxable, both exempt, and exempt. But here the intent to hold, yes, it is exempt. But if he sold, let's say if he sold before 12 months, it would be taxable also. It would be taxable also. So that's why I put the taxable in and then cross. So here I'm adding the same point again for FTA guideline actual. For capital gain, actual holding 12 months. City law is saying actual or intent to hold 12 months. Ministerial decision, no comment on this point in this regard. What that means, we already discussed in previous slide also. City law is saying if a dividend is actual or intent for 12 months, and for the capital gain also actual or intent to hold for 12 months. Okay. But the FTA guideline is saying for capital gain, actual holding is a 12 months. Actual holding is a 12 month. So what we understand, what we discussed in the previous session, would you please anybody recall and share what we discussed? What is our understanding? Anybody would like to share what we understand, what we discussed? See, the dividend capital gain normally come after capital gain will be arise when upon the sale. Upon sale, we already knows is holding we we hold that asset for 12 months or no. If at that date we know if this is we did not hold for 12 months, so for sure we will make will make him the taxable. Will consider as a taxable, right or no? So we may consider the FTA guideline. Actual holding is the 12 months, but there may be a scenario where you have more than 5% holding. Let's say the 10% holding, and you are selling the 2%, 3%. But even after the sale, you are having the even after the sales, even the after sale, you have the more than 5%, which means you still maintain the PI condition. So then even you made this is the exempt, but FTA guidelines saying it will be subject to actual condition. If later on you sold the asset before 12 months, then it will be taxable in that year. So make our understanding refine. So let's consider the actual holding in terms of the sales 12 months. Although effect will be, there's no difference, only the cash flow benefit will be there. Same in terms of the dividend and same in terms of the capital gain, because in the year of sale, even you have intent to hold for 12 months, you will not pay that tax. You can postpone, you can delay that tax, because you will reduce your you will minus that gain from your accounting taxable profit, which means in next year, if you sold, it will be taxable. The tax you have to pay this year, you are going to pay next year. This will be the temporary difference. This is not the permanent benefit. This is only the temporary benefit. You may enjoy the cash flow benefit, subject if the amount is substantial. If the shares are sold, this is the other point. If shares are sold before 1 year, then dividend or capital gain or losses will be taxable in the year of sale. The same point we are discussing previously. I'm just summarizing. So let's take the illustration. Company A, UAE, subject to city is 9%. I think this is the same example. Okay, no, this is not the same, different. Okay. Let's say the company A, UAE company. Company B, UAE company, 9% investment is this. Holding period is this in the first taxable period. Then the another shares, the 10%. Again, the UAE company investment is a 5 million, holding is a 3 years. Now the dividend received in the tax period July to 31st June. Dividend received in the tax period. This is the tax period. So here, this is the UAE company. If the UAE company, you are receiving the dividend, this will be exempt. And here you are meeting the condition and you are holding the more than 3. Again, it is exempt. Both dividends are received from the company B and C are exempt without any condition, 5% 12 months, because UAE company. Illustration 2. A UAE company subject to 9%. Here the shares is 20%. Company B is a UK company. Investment is a 10 million, holding is a 6 month, but actually intend to 3 years. So if actually intend to 3 years, so dividend will be exempt. Dividend received in the tax period 1st July to June. It will be exempt or taxable? Exempt, okay. Example. Let's see the next example. The Bermuda 10% shares. City is 0%. Now the dividend will be exempt or taxable quickly. Okay, if shares are sold before 1 year, the dividend will become taxable in the year of sale. That UE company subject to City 9%, 4% share capital. Again, first UE company. Person. Company B. Here we have to continue the this example. Keep in mind this company is a UAE company. Okay. We'll just continue the same example. Disposal of share in company B in the second tax period. So this is the second period. Holding period is less than 12 months. So it will be taxable or exempt. It will be taxable or exempt. Yes, even this is the UAE company, but it's subject to PI condition, and the PI condition 5% shares. This condition is not meeting. And the second holding period is less than 12 months. Dividend received in the first tax period will remain exempt, but the gain on disposal will be taxable due to less than 4 million investment and less than 12-month holding period. Why dividend is exempt? Because UE company. That's why dividend is exempt. Otherwise, that if foreign company, that also will be subject to tax. Now quickly the 10% shares, the same example, the company C. If you're gonna see that, what the company C? Here is the company C, UE company, 5%, 5 million investment. Disposal of share in company C in the second tax period. Holding period is more than 12 months. Holding period is more than 12 months. This will be exempt. Gain on disposal will be exempt as well as 4 million investment and more than 12 months. Both conditions are meeting. Now, the previous, if you want, I can show you the example of the previous. The B company, 20% share, UK company. Okay, investment is at 10 million. So investment is 10 million, 19%. So now let's see in the second year what he do. UK company subject to 9%. Company A, Union company, subject to 9%, 20% shareholding. Company B, disposal of shares. I think it will be the UN company. Okay. He have the share in the UK. This is the B company. This will be exempt or taxable. Why? Why is taxable? Why is taxable quickly? Less than 12 months. Dividend received in the first tax period will become taxable in the second year. Gain on disposal also taxable due to less than 12 months. Dividend from UAE resident person exempt dividend gain received from the foreign participating that we already seen. Now let's see. Condition: no election requires participation exemption. Do we have any election? In this regard, no election. No election automatically we can do. No election, no application. Participating interest of more than a 5% shareholding voting right and net asset on liquidation. Asset must be held for uninterrupted period 12 months. Minimum acquisition cost 4 million. 4 million at the time of the contribution or repayment. Ignore the fair value change. This is just summarize. I'm summarizing the same point that earlier we already discussed. No participation exemption for dividend which are deductible. No double taxation relief. No double taxation relief also. Tax assets subject to tax in its country more than or equal to 9% in their jurisdiction. We already seen the effective rate of tax, how to calculate on the accounting profit. Bad asset test, we already seen. Net income exemption, we seen. Breach of condition will become taxable in the year of breach. Special rule and relief: if losses are recorded for the participation, then up to that losses, no exemption. Hope you understand this point. We have the example today. Losses on sale of participation. Losses on sale of participation interests are allowable. Okay, losses on sale of participation interests are allowable. Holding companies not otherwise meeting condition if principal activity to hold shares and income substantial from those shares. This we already seen. And holding company not otherwise meeting condition if principal activity to hold shares. Okay, the holding company, they are generating the business from the investing in other company. There is no other activity. The definition we understand. Participation in the qualifying free zone or exempt entity may be eligible for exemption subject to condition to be prescribed. We already understand that also. Question yet to be answered. Criteria to determine the intent to hold. Okay. That we already discussed. Free zone participation criteria: beneficial versus legal ownership. Minister may prescribe minimum ownership met based on the acquisition holding period. These are the further question that here we already discussed the actual period. We make our understanding in terms of the capital gain. In terms of capital gain, the actual will be 12 months. Minimum is 12 months, and in certain one of the scenario, 3 of the scenario, it will be 24 months also. Free zone participation exemption. The free zone we already discussed in the previous. Free zone also will be if qualifying free zone, yes, it will be receiving the dividend will be exempt. The minister may prescribe any minimum ownership requirement based on the acquisition on the cost threshold. Any of these are the additional questionnaires, so that we already covered most of our topic. Let's do the complete this example is from FTA we taken from the determine the taxable income in the following example. Assume all the parties to be taxable person. Here the assumption we have to take all the taxable person. JLLC, a UAE resident company, buy a 10% share in the K. So J. Okay, resident in country A. Resident in country A, fully subject to corporate tax in A and in the tax period of 31st December 2025. 1 million. 10% shareholding in J. Okay. To receive, okay, 10% shareholding entity JLC to receive 10% of K distribution of profit and 10% of the. So here is saying the further condition. Asset test. In terms of liquidation, they will receive, okay, 10%. The profit also they will receive the 10%. This condition you know we already seen the more than 5% the profit and the liquidation both are meeting. In the tax period ending 31st December, J LLC received 14 million in cash dividend from K. Here he receives is 14 million dividend. Now, this 14 million is a taxable or exempt? This 14 million is a taxable or exempt? Okay, let's see. Dividend received from company in the year of dividend received from company in the year of 31st December will be exempt. Okay, now let's go to the next example. In the tax period ending 31st December, GLSC sell part of his shareholding. This is same example continue. The same example continue. I just want to show you. Here is a 10%. Just keep in mind 10%. So how much he sold? How much he sold? After which it left 3%, which means 7% sold. Do this is a PI or no PI? After the sale, it will be PI or no PI? I appreciate if you just bear with me another 15 minutes. We will complete this because about to finish. And due to Ramadan timing, is critical because prayer and all that. So this is the no PI. So, but whatever the gain he will come upon this sale, because before the sale he was PI, and we have to see if he's meeting all the conditions, this gain will be maybe exempt because this is after I'm talking about the 7%. Now, first, guys, here you have to see when he sold in this date. So this 7% he sold, before that he hold 10%. So at the date of this sale, at the date of this sale, he is meeting the PI. Right or no? If it's yes, so this gain will be taxable or exempt? If this will be taxable or exempt? Afterward will be 3%, then whatever the dividend or gain that will be taxable. Yes, we need to check the period. So what we are gonna see that. So because this is the 25. Here he said the 25. Okay, let's say the 25. So which means 1st January 2026, the 12 month is completed. So here is saying 31st December 2027. Hope you understand the point now. Determine the taxable income on the following example. Assume, okay, the same. In the tax period 28, J receive 3,000 in cash. Now this dividend, taxable or exempt? The same example is continue. Same example is continue. Quickly, guys, quickly. It will be taxable because from the December 27, our shareholding is less than 5%. Okay. Effective tax rate is based on the accounting profit calculate as per the IFRS. So tax paid or accounting profit as per IFRS 9% or more than test met. No need to met. No need to met subject to tax asset for the four companies qualifying. Okay, this is the information. Qualifying free zone, effective qualifying free zone. Okay, this may be holding companies come under holding companies are the SBR. Holding company means which are having the qualifying investment. Again, this is the same point we are discussed. Let's come to the example. Why I'm repeating the same points? Because these are the key notes. These are the key notes that we are adding on different slides again and again. Because this is the repetition, we need to focus on that. If you focus on that, this is the your fingertips. You will quickly proceed whatever the main concept you are moving on that. Let's see this example. Company A, incorporated and resident in UAE. First is the resident, because in certain scenario, resident also we have to see. Second is the okay, same UAE resident, hold 100% share, incorporated and manage. No, company A shares of B. B is managed a company incorporated and managed outside country. This is the foreign company. Company B is a resident in the B, which leave the corporate tax is the 5%. So this 5%, so it will meet condition or no? We said the effective tax rate will be 9%. So considering this 5%, we are eligible for PI exemption or no? Irtada Bukhari. Irtada Bukhari. Khalil, yes. Yes, so I appreciate one of the participant, one of the Irtaza Bukhari and Khalilur Rahman, 11%. I appreciate Irtaza Bukhari if you volunteer yourself and unmute yourself and Irtaza. Would you please unmute yourself? I'm just now try now. Okay. What that means, because he already calculated she already calculated the full point. Anyhow, let's continue. In order to benefit from the participation exemption, company A would need to be demonstrate that the income from the participation is subject to effective taxation of at least effective taxation of 9%. Okay, but here the tax rate is 5%. In respect of the current tax period, company B paid total corporate tax is this one in the country B, and the entity has accounting profit before tax is 50,000. Do you think company meet the conditions? Now, would you please calculate the effective rate of tax? Would you please calculate the effective rate of tax? Guys, quickly. So now 11%, okay, the 11%, which means now is meeting the condition or no? Now is meeting the condition or no? Means we already said even the effect corporate tax in the foreign country is less than 5%, but we have to see the effective rate. So if we see the effective rate is 11%, which means it's meeting the condition. So this is because before this training, most of the participant may be understanding the effective rate. We have to just look the foreign tax rate. But now you understand that how to calculate the effective tax rate and what the information is required based on the accounting standard, based on the IFRS. Even the foreign tax is calculated based on the taxable income is calculated based on the US GAAP. You have to recalculate on the IFRS. Then you have to calculate the effective tax rate, and maybe this meet the condition of the PI. You can enjoy the benefit on that. So Khalil, please avoid to write on the screen because now you just already made this. Anyhow, let's see the answer. You already covered that point. Let's see the effective rate based on the okay, the almost the same example, 5.5%. For the current tax period, company B paid tax of 4,000 and the entity has accounting profit before tax is a 50,000. According to the local accounting standard, so the actual effective tax rate is the 8%, is the below is the 9%. When applying the IFRS, the accounting net profit of the company would be 40,000. Now, please now it's okay. Now, please, maybe you can raise from your side. It will be, Mr. Khalil, it will be good from your side because you're written, so you might raise that also. Now, please calculate again the same effective rate of tax. Guys, please calculate the effective rate of tax. There is the 2 points. This is the Isra Bukhari is the first point. Please complete the next line also and do again. Miss Kinjal is set the 10%. Khalilur Rahman 10%. Raja is at 10%. Let's take one of the participant and take the understanding. Okay. Okay, Ms. Kinjal, would you please unmute yourself? Would you please try unmute yourself? I think now most of the participants. Yeah, now it will be well. Ms. Kinjal, would you please unmute yourself? Or Mr. Shahab also is try now because earlier the setting was different.
Hello.
Yes, please explain this last point, how you calculate that.
So they're saying the profit is 40,000 accounting net profit. So we need to derive 4,000. We need to calculate as 4,000 divided by 40,000.
Why 40,000? Why not 50,000?
So there is a IFRS, there is a changes in taxable income. Like this 50,000 is tax profit. And as per the concept, we need to check the accounting profit. So that's why.
As per the city regulation, as per the city regulation, we have to take the IFRS
Accounting.
because here yeah, Here in UAE, accounting standard is the IFRS, followed by IFRS. Then, okay, thank you. So now, guys, mostly I think yes, Muhammad Dev accounting profit, because in UAE taxation, the 9% means the UAE IFRS, UAE following the IFRS, and the same we will follow over there. Anyhow, let's you guys understand. This is the reason here the 50,000 is the local standard. The word is a local standard. So then the next he said, when applying the IFRS, accounting profit will be 40,000. The local standard is saying the accounting profit is the 50,000. Okay, accounting profit 50,000 based on the local. But what we need as per IFRS, then it would be 40,000. 4,000 divided by 40,000. Let's see the next non-qualifying asset compared to total asset. This, yes, guys. Now, please read and solve this. We already did this understanding. A company A incorporated and resident in the UAE hold 10% of the share of the company D. A company incorporated and managed outside UAE, foreign PEI. A company D in turn directly or indirectly hold share in several subsidiaries. Okay. The consolidated balance sheet of the D shown the following book value. Total asset is 100, investment ownership is 60,000, consisting of qualifying in ownership interest 20,000, non-qualifying is 40,000. Now, please quickly, we already did this calculation today. So now I hope you can solve this. Yes, please, quickly. What is the rule? What is the rule? In terms of the bad asset, what is the rule? Today we learn in terms of the bad asset, what is the rule? It should not be more than 50% of the total asset. Okay, this also you guys understand. Let's summarize participation exemption article 23. No election required, automatic condition. Participating interest of more than or equal to 5% ownership interest, which is the equity interest with the right to profit is distribution and liquidation of profit, or the minimum acquisition cost is a 4 million, including the expenditure 4 million value at the time of the contribution and repayment, ignore fair value, plus must be held or intend to held for uninterrupted period of 12 months. Investment in foreign participation, exchange rate at the date of acquisition. No participating interest exemption for dividend which are deductible. Okay. No double taxation relief also. No double taxation relief also. Here, what we're seeing in the foreign PI, if they already recorded in the profit and loss, so that will be tax already. There is no. So that will be not the PI exemption. Okay, because we not made the investment as the equity. Okay, now the asset test 9%. Effective rate of 9% participation. Just now we seen the example that income an exemption, breach of any condition. Thank you, guys. Thank you, guys. If you have any question, so this topic is covered. So now next topic we will see.